once you understand the macro dynamics and drill through to the cost of capital, into the discount rate, and then the impacts on the valuations, you can now start to look at portfolio theory. Okay? Start aggregating portfolios of different assets, either different asset class, multi-asset classes, or single asset classes. So when you're building these portfolios, which you're going to apply to portfolio insurance, you're going to start off with the portfolio standard deviation, which we already know what the calculation is. So really, at the end of the day, is based on the covariance, on the correlation. And you're going to have the expected return on the portfolio. You're going to start, traditionally, at the origin, at the risk-free rate. Now, what's interesting is in Europe and in Japan, their capital allocation lines start at negative interest rates, which kind of perverts, this analysis. But I'm not going to go into advanced portfolio analytics based on negative interest rates, although I do talk about it in the exam. So you start with the risk-free rate. And then you have what is called the efficient frontier umbrella. And every point along this umbrella, and inside the umbrella are feasible portfolios that you can construct in the capital markets. Anything outside are infeasible portfolios. You cannot construct it. So that's the efficient frontier. And you could have a 100% stock portfolio where you're going to get higher returns at a higher given level of risk. You could have a 100% bond portfolio. You're going to get significantly less risk, but significantly less return. You can, if you want to take on more risk to get a higher rate of return, you can move up the efficient frontier by selling off your bonds and buying more stock. If you are willing to take less return because you want less risk, you can sell off your stocks and buy more bonds and reduce your return and reduce your risk in the process. At the point in which the efficient frontier is tangent to the capital allocation line, along with the tangency in utility curves for risk-averse investors. So it's a matching between the capital markets and investor preferences. Now, investors want to be out here. They want high return and low risk, but there's no portfolios out there in the capital markets that are going to give you high return and low risk. So what they need to do is they need to move down and lower their utility until they reach the tangency point where their utility curve touches the capital allocation line in the efficient frontier. At that point, this is going to be the market basket, which is similar to indexing the market. It's like the S&P 500, let's replicate that. But in this case, it's like, how big is the stock market? How big is the bond market? Add them together, divide it back. 60% or 70% are bonds, 30%, 40% are equity. I'm going to build my portfolio 70% bonds, 30% stock, because that's how the universe is encompassed. And at the market basket, the portfolio standard deviation is minimized and the expected rate of return is maximized. It's the point at which you can, that this is the highest expected return that you can get at the lowest amount of risk. And your risk-adjusted rate of return at this point is also maxed out. Now, there are asset classes such as private equity. These are called alternatives. Investments. Private equity real estate. Cash value. Life insurance. Alternative, renewable energy, guaranteed annuities, and other types of asset classes and assets that are alternatives that have low, no, and negative correlation with returns on stocks and bonds. Stocks and bond returns, as we know from the valuation equations, are extremely sensitive to movements in inflation expectations and interest rates. These asset classes do not move with movements in interest rates in a lot of cases. And they're private markets, not public markets. These are publicly traded securities. These are privately traded securities. So by adding these alternatives to your stock bond portfolio, this is the key right here, is the magic, is what it does is it actually bows out the efficient frontier. It bows out the efficient frontier. Because these returns on these alternatives, assets, their returns have low, no, or negative correlation with stocks and bonds. So what it does is it bows out the efficient frontier, reduces the amount of return, but significantly reduces the portfolio standard deviation, which causes the risk-return ratio to go up significantly. So by adding private equity real estate, cash value life insurance, alternative renewable energy, guaranteed annuities to your stock bond portfolio, it bows out the efficient frontier. Yes, it reduces the expected return, but reduces the portfolio standard deviation significantly more, causing the risk-adjusted rate of return to go up. Therefore, the risk-averse investors are better off. This is a form of diversification. So this would be one form of risk management or financial engineering, by putting these products into your stock bond portfolio to create diversification, to mitigate and reduce portfolio risk or standard deviation significantly more than the reduction of the return. Now, the cash value life insurance, even though it's not in the book, is also a financially engineered product based on life expectancy and payments of the premiums. Cash value life insurance and return on life insurance policies have very low correlations. Their returns have very low correlations to stocks and bond returns. So if you add cash value in there, it's going to bow out the efficient frontier. But here's the key, is if you die, there is a wealth effect through the death benefit that pushes the return on the portfolio up to a higher utility for your heirs. Now, this is not only applied at the individual level. Bank corporations, banks, financial institutions have life insurance policies on their senior level executives called bank-owned life insurance, and it's cash value life insurance. And the cash value in the life insurance is considered a tier 1 liquid capital. And if any one of the principals passes away, the financial institution is injected with liquidity due to the damaging effect of losing one of their key personnel. So it's a way of actually jumping off to higher utility curves through the use of this type of engineered product. If you buy put options on futures contracts, you think that the value of your portfolio is going to go down in the future, you can buy put options on the futures contracts based on the stock and bond indexes. Now, the puts are going to cost you money, so your expected rate of return goes down. But if the interest rates go up, or the stock prices go down, or bond prices go down, you're going to be in the money on the put options, which is going to compensate you for the loss in the portfolio, so it bows out the efficient frontier. That's called portfolio insurance. It's called portfolio insurance. And you can also write the calls of the futures. You can write forwards, contracts. You can write the futures, contracts. And all of those, again, are going to hedge the downside risk of the portfolio, bow out the efficient frontier, increase the risk-adjusted rate of return, and immunize the portfolio through the use of the derivative contracts. If you structure these and create derivative portfolios and start to manage them through combinations of derivatives as opposed to holding the underlying assets in the portfolio, you've now created postmodern portfolio theory through the use of synthetic derivative contracts. You've now gone beyond modern portfolio theory into postmodern portfolio theory. Okay. How are we doing on time?
6:30.
How much time do we have? Where are we
10
at?
minutes.
Okay. The last piece, we did go through yield curves. We went through forecasting. You may want to write these notes down right here so you can answer this piece. What is the size of the Federal Reserve's balance sheet and held on reserve at the Federal Reserve? 4.5 trillion.
What?
4.5 trillion. What was it prior to 2000? 2007, 1 trillion. What has been the growth of the money supply since 2007? In the financial crisis, the money supply grew at 30 to 40%. Thank you. During the financial crisis, the money supply grew at 30 to 40%. Then it slowed to 10% per year, and it's now growing at 5 to 7. What is the, has the Fed hit GDP, gross domestic product? No, because it's at 2% and they're shooting for 3. So they did all this quantitative easing, lowered interest rates with really no effect on gross domestic product growth rates, real. They should be, we should be in the 3 to 4 range, we're at 2. Okay, and 1.5. Employment and unemployment, we're at full employment currently, and inflation targets, we're finally starting to hit them. But inflation has been very low for 9 years. So actually the Fed did not hit its target. It hit its unemployment targets, but didn't hit its GDP or its inflation targets. If we were to fall into a recession, would the Fed use negative interest rate policy? Yes. Yes, just like the Europeans and the Japanese. They already said that they would do it. What would be the impact on the economy, asset prices, savers and investors and businesses. Well, it may stimulate the economy by devaluing the currency, because negative interest rates are negative. Well, if asset prices, remember the valuation equations, if interest rates go negative, then asset prices are probably going to go up. For savers and investors, it's horrible, right? Because you're buying bonds at negative yields. So it's horrible for investors and savers. And for businesses, it depends. They would be able to borrow cheap, as you saw from the weighted average cost of capital would be cheaper. But what if negative interest rates have a negative impact on aggregate demand? Then their earnings per share and their cash flow growth rates will be less. So are they going to benefit more from the reduction in the cost of capital to drive up valuations, or are they going to get hit more by deterioration in cash flow growth that's going to hit their stock prices? We talked about yield curve dynamics. We talked about yield curves in the S&P 500. Economic indicators and targets. I asked you, just like we did today, can you give me where the stock market is, oil, gold, 10-year treasury, and foreign currency. Dynamic supply-demand analysis. Do we need to go over that again? We went over that last class. For stocks, bonds, oil, gold, bonds, and currency. Being able to shift out the supply and demand curves, the demand curve up and down and the supply curve back and up for the different asset classes. Can you conduct the microeconomic analysis? Financial product innovation in engineering. I might have to do that next time. Along with the technical analysis, we did do the portfolio one, so you can answer that one. Derivative trades, we talked about those. Technical analysis, I'm looking for in the technical analysis just a chart where you have a trend. Can you show me the support? Can you show me the resistance? Can you show me the breakout to the upside? Can you show me a breakout to the downside? Can you show me a sideways pattern or a consolidation or accumulation in the pattern? And then a upward trend line. So just rudimentary technical analysis is all that I'm looking for on the technicals. When you draw the charts and show me some technical analysis. And then we did go through the valuation methods, except for the DCF. But you know that the DCF is just the sum of the cash flows and the discount rate, right, plus the terminal discount rate, discounted back. So you know if interest rates go up, present values go down. Right? If interest rates go up, multiples go down. If interest rates go up, the Gordon growth valuations go down. If interest rates go up, perpetuity. So can you write in those equations here and show me that you know perpetuity and Gordon growth and multiple and DCF? And I think that's it, other than the financial product side. I'll save that for the midterm. Okay. Is that enough? Did I give you enough information to be able to answer those questions? Along with the video, if you want to watch it again. Yeah. Okay. Is a lot of this